Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, March 6th, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story this week is the escalating Iran conflict and its ripple effects across global markets. Oil prices have surged to 22-month highs, with WTI crude topping $86 and Brent breaking above $89 per barrel. Qatar's energy minister issued a stark warning that prices could reach $150, and more concerning, he stated the war could force the Gulf to stop energy exports within days. This is transforming the entire risk landscape. We're seeing what some analysts are calling an everybody loses scenario, where the classic 60-40 portfolio strategy is breaking down. Emerging market currencies and equities are headed for their worst week since the pandemic, and credit traders are rapidly unwinding what had been a gigantic bullish position. The bond market is experiencing a significant rout, even as stocks attempted a midweek rebound on hopes of de-escalation. Maersk, which is a key bellwether for global trade, has suspended two key shipping services due to the conflict, which tells you how serious the supply chain implications are becoming.
That's a major shift in the risk environment. We've gone from worrying about inflation cooling to potentially facing a supply shock. What does this mean for traders and investors right now?
The immediate concern is that this conflict is hitting markets at a vulnerable time. The Dow, S&P 500, and Nasdaq did rebound midweek on de-escalation hopes, but that appears fragile given the bond market's continued stress. Energy stocks are the obvious beneficiary here, though some analysts are warning that certain gas stocks are overinflated at current levels. For traders, the key is recognizing that we're in a regime where traditional diversification isn't working as expected. The correlation between stocks and bonds has shifted, and safe haven flows are behaving unpredictably. Microsoft's energy chief made an important point that this crisis strengthens the case for renewables, which could benefit that sector longer term. But in the immediate term, we're seeing sector rotation into energy and defense, while consumer discretionary faces pressure from rising gasoline prices. Trump stated he's not concerned about gas prices jumping over the last week, but consumers certainly are, and that's showing up in sentiment data. But the trade recommendation here is defensive positioning with selective exposure to energy, but avoiding overextended names and keeping powder dry. Because if Qatar follows through on export disruptions, we could see another leg of volatility that creates better entry points.
That selectivity is going to be critical in this environment. Steve, let's turn to the economic calendar. We've got some important data today. What's the picture looking like?
Thanks, Robert. Earlier this week, we got several important reads on the economy. Initial jobless claims came in at 213,000 on March 5th, right in line with the forecast of 215,000 and unchanged from the previous week, showing the labor market remains stable. The ISM manufacturing PMI released on March 2nd came in at 52.4, beating the forecast of 51.8, though down slightly from the previous reading of 52.6. That's still solidly in expansion territory above 50, which is encouraging for the manufacturing sector. The ADP employment report on March 4th showed 63,000 jobs added, which actually beat the forecast of 50,000 and was a significant improvement from the previous reading of 11,000. Now, today is the big one. We're getting non-farm payrolls, which is always a market mover with very high volatility impact. The forecast is 59,000 jobs added, which would be a notable slowdown from the previous reading of 130,000. This is a critical number because it measures the monthly change in employment, excluding farm workers, government employees, and nonprofit organization employees, and it affects all sectors of the economy. If we come in below that 59,000 forecast, it could raise concerns about labor market softening, especially combined with rising energy costs. We're also getting retail sales data today with a forecast of 0.3%, and unfortunately we don't have the previous reading for comparison, but this measures total receipts of retail stores and is our key gauge of consumer spending patterns. This affects both consumer discretionary and consumer staple sectors. Given the concerns about rising mortgage rates and energy prices that are dominating headlines, the retail sales number will be particularly important to see if consumers are pulling back. These two releases today will give us a comprehensive picture of whether the economy is maintaining momentum or starting to feel the pressure from recent geopolitical developments.
Those are critical data points, especially with the uncertainty around energy prices. Lizzie, let's shift to our stock of the day. We're looking at AST SpaceMobile. This has been quite a volatile name. What's your analysis?
AST SpaceMobile, ticker ASTS, is one of those high-risk, high-reward stories that really divides investors. The company is developing a space-based cellular broadband network using Bluebird satellites that enables standard smartphones to connect directly to satellites without any additional hardware. The stock is currently trading at $93.86, and it's had a remarkable run, up 192% over the past year, from around $32. It hit a 52-week high of $129.89, so we're about 28% off those highs right now. Year to date, the stock is up 12.45%, which is actually underperforming the broader market despite the positive momentum. Now, here's where it gets interesting. The company just announced a partnership with Thales in March that sent the stock surging 13% to $104.89. This partnership includes an equity investment and joint infrastructure build-out, with service launch targeted for late 2026 in Canada's remote regions. They've also partnered with Orange for European expansion, with demonstrations planned for 2026. The company has an impressive roster of telecom partners, including AT&T, Verizon, Vodafone, Telus, and Orange, which validates the business model. What really caught the market's attention is that Alphabet, Google's parent company, became a significant investor with ASTS, representing their largest investment holding. That institutional backing has attracted substantial capital.
The partnership sounds solid, but I'm looking at the valuation metrics here and they're eye-watering. How are you evaluating the risk-reward at current levels?
You're absolutely right to focus on valuation because this is where ASTS gets challenging. The forward PE ratio is 6,762, which is extraordinarily high and reflects that this is essentially a pre-revenue or very early revenue stage company. The price-to-book ratio is 14.55, substantially elevated compared to industry norms. We're talking about a $35.7 billion market cap for a company that's still in early commercial stages and remains unprofitable with no dividend. 8 analysts cover the stock with a consensus rating of hold and a target price of $88.53, which implies 5.7% downside from current levels. So the market is currently pricing in substantial success with very limited margin of safety. The bull case is compelling. They're addressing connectivity gaps globally, which represents a multi-billion-dollar opportunity. They have first-mover advantage in direct-to-device satellite connectivity, and that institutional support from Alphabet provides financial credibility. However, the risks are significant. Execution risk is paramount because they must successfully deploy the satellite constellation and achieve commercial service milestones by 2026. There's technology risk since this is unproven at scale, and competition is heating up with SpaceX's Starlink, Amazon's Project Kuiper, and others entering the direct-to-device market. The company is burning cash with significant capital requirements for satellite deployment, and those service launches have been pushed to late 2026, extending the path to profitability. My year-end 2025 target would be $85 to $95 in a base case scenario. Assuming sideways trading pending those 2026 service launches, conservative case would be $75 to $85 if execution concerns emerge, and bull case would be $110 to $130 with successful deployments and additional partnerships. The verdict on buying the dip: I'd say this is not a buy the dip situation at current levels. The stock is trading above analyst targets, and we're 28% off the highs, but still at premium valuation. For current holders, consider trimming positions given that premium to targets. For new investors, I'd wait for either a meaningful pullback of 15 to 20% or concrete evidence of successful commercial service launches in 2026. This is appropriate only for aggressive growth investors with high risk tolerance who can withstand significant volatility. The 2026 service launches represent critical inflection points that will determine whether that $35.7 billion valuation is justified.
That's a thorough breakdown. It sounds like patience might be the better strategy here, rather than chasing the momentum. Let's wrap up with crypto. Lizzie, what are you seeing in digital assets?
The crypto market is showing cautious and uncertain sentiment heading into next week. Bitcoin is facing what some traders are calling a potential bull trap at the $74,000 level. The price pulled back to around $71,000, and we saw an anomalous outflow with 32,000 BTC leaving exchanges in a single day, while Bitcoin miners have offloaded 15,000 BTC since October with more sales expected. CleanSpark alone sold 553 BTC for $36.6 million in February. Bitcoin spot ETFs logged 228 million in outflows, which adds to the bearish pressure. However, there's a silver lining. Institutional investors haven't been shaken, according to CoinShares, and Lynn Alden is tipping Bitcoin to outperform gold over the next 2 to 3 years. The sentiment for next week is neutral to bearish, with $70,000 being a key support level to watch. Important factors include institutional investment flows, miner activity, and any regulatory developments around Bitcoin ETFs. For Ethereum, the picture is similarly cautious. Ether is struggling around the $2,200 level, and short sellers, including Culper Research, are betting against it, citing death spiral risks. Ethereum derivatives open interest dropped 5.62% in a 24-hour leverage flush, and traders see the path to $2,500 as trickier than expected. However, some traders are looking for a larger bounce after ETH tapped 2,200. Vitalik Buterin called for bolder experimentation in Ethereum's app layer while preserving core principles which could drive innovation. Next week's outlook is neutral to bearish, with 2200 being critical support. Watch for network activity and layer 2 adoption. Solana presents a mixed picture. Solana ETFs are holding impressive numbers despite the token diving 57%. But the Solve protocol exploit that drained $2.7 million may dampen sentiment. The Doppler platform is expanding to Solana, which is positive for ecosystem growth. Overall, the crypto market faces continued volatility, with defensive positioning recommended and close attention to those key support levels.
Cautious positioning seems to be the theme across all asset classes right now. Well, that wraps up today's Morning Bell. We covered a lot of ground, from the Iran conflict's market impact to the jobs data we're watching today, ASTS SpaceMobile's high-stakes growth story, and the uncertain crypto landscape. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you never miss our daily market analysis. I'm Robert, thanks to Lizzie and Steve, and we'll see you next time.